Here we go. All right, so we have begun recording. Welcome, Happy New Year. It is January 4th, 2024. I'm Tim Quast. Thanks for joining the Edge live demo and discussion. 2 rules, please mute yourself while we're having this discussion. But then, and sometimes I get going, just ask questions. If I miss it, interrupt me. I don't mind at all if you say, hey, Tim, I've got a question on what you just said. Just interrupt. You can use the chat function. You can just unmute yourself and fire away. So I've got Brian Wilson, market strategist and a veteran. You know, spent 9 years as a buy-side trader. He's spent a lot of time trading. He knows market structure. He supports our most important corporate clients. So he is a crucial part of our organization, and he will cover part 2. I'll do part 1, and I'll try not to tromp on the turf that Brian intends to tread. So stop me if I do, Brian. Okay, so we'll try to do this, in 35 minutes. I went 40 last week with apologies, so we'll shorten it up a little bit. I'm going to share my screen, and what I try to do, I always go back and look at the market desk notes that we have sent out before I do these to make sure that I do what we talk about there. I want to talk about being aware of what's going on around you. I just think that that's very important. We call it context. That's number one. I want to look at some data that supports that, and then talk about understanding demand and supply. To me, it's very simple, and it's not perfect. We can look at a couple of examples like coin. You can say, well, coin's still got great supply-demand divergence. Why isn't that working? Well, we could talk about that. It doesn't work every time, and it really does come back to the broad themes. I had an exchange with a public company, a large, everybody would know who it is. The guy who founded it is a big sailor. I'll just tell you that. So if you can figure that one out, that you maybe can. We were, I'm talking with them about how they're doing the same things they did before, and yet the amount of money that is picking stocks has collapsed in the market. I don't know if John's here today, but he sent an item from B of A saying, well, clearly there's a majority now of money in the market that is running on models. I looked at their top 5 holders in this particular case, and they own 25% of the outstanding stock, and they're all to 5 are passives. I mean, they just dominate the market. So then, when that kind of money changes its allocations for whatever reason, macroeconomic inputs, you and I with our 401k plans where we say, I'm not sure I want to be that exposed to equities. Can we make some adjustments? Those things are going to flow through the market, and we're going to see it in broad sentiment. Broad sentiment is a great reflection of the way that the dominant investment behavior of the day behaves. And that is principally BlackRock, Vanguard. We could go down the line, Fidelity, State Street, Fidelity's unit that they spun out called Geode Capital, as I've mentioned this before, exploded, gone from 200 million in assets to 1.4 trillion. And it's happened just, whoa. It's everywhere in our corporate client base. They're in the top 10 of every single one. Well, it's indicative of how money behaves. So it's very important to understand what those broad trends are, because you can't fight them. And so you want to be aware of those things. This is what I mean. When I say context, we think of context to mean there was a calendar in the market. We talk about that a fair amount. If you hit Edge and going over here to a browser and looking at Market Structure Edge, and looking at resources, there's an expirations calendar. Well, it's very important. The use of derivatives has absolutely exploded. I don't have that image in front of me, or I'd share it with you. Actually, we shared it in the client services group, right, Brian? If I can find it, I'll share it with you. Is it here? This is the client services team. Yeah, we're always sharing data, So yeah, here it is. So this came also from John Cook. So he sent this to me via direct message on X, formerly Twitter, and it's just showing the incredible explosion in the use of derivatives? Well, that's very important to know. This happens to be tied to the S&P 500. It's an enormous part of market volume. So you want to know when those things are resetting. So going back over here, this is the expirations calendar. There's nothing expiring this week or next week. Earnings start next week. I'll zoom that in a little bit. So, earnings really kick off with the banks next week. I think then there's some others. Beware of those things. I think it's very important for traders not to just be, beginning each day as though it's the same as yesterday. It's not. There's a clock ticking, time's running. It's like it's a sporting event, and you have to be aware of those things. The week of the 15th, you've got a holiday, and then 17th, 18th, 19th are all expirations dates. And what broad supply and demand are doing into that is going to be telling. I don't know what it's going to be doing. At the current rate, I would say it would be bottomed and could rise out of that. Now, we'll see how that goes. But knowing what is going on is very important because it's the best way to avoid losing money. And it happens to me too. I looked at Apple, and I realized that there's right now, and I think Brian's going to talk about this a little bit about what he thinks of the big tech. So I won't spend a lot of time on it, but I do want to go over here to Edge and note this, that if you look at Apple, it was in the low volatility portfolio. It may still be, I didn't check. And it was, when it was down, all of its volatility, and it's got good demand and falling supply, I look at that and say, well, that's pretty appealing to me. But it didn't work. I got stopped out of it. And it's a continual reminder to me not to try to buck the broad trend. It is very difficult to do. I traded SWK today, and I made a modest amount. I said, you can't make much money on the long side when this condition exists in the broad market. You look at the broad sentiment here, and it's not that you could say, well, didn't it do the same thing here? I'm talking about the green part of the graph, right? So if we look at the green part of the graph, the 10-point scale of demand in the market and how it peaked, right around Christmas and began to deteriorate. And well, it did it back here too. You'd say, well, why did the market continue up there? Well, if you go down and look at the supply side had peaked of November 30. And it was the only time where we had that brief, the market was flat here. It didn't really do anything. It's paused. And then demand began to deteriorate. Prices came down just a little bit. And then the supply just imploded. So it's very important to see those things. And what's happening now is this kind of condition again, coming out of November, options expiration is very strong, rise in supply, but demand was very strong then. Now it's deteriorating. So you get this image that I put in the market desk note on, when was that? I think it was January 2nd. I drew this. So I'm going to zoom in so you can see this. And that might have been too much. But I drew this arrow. This is the condition that you look for to tell you it's going to get very difficult to trade momentum and even low volatility. Low volatility is a good reflection of the market, but producing a reliable long return gets very difficult when this condition develops on the demand side and this condition develops on the supply side. I don't know where that's going to go. It could stop at any point. But you would think I would learn. Last August, I got stopped out a number of times because I was trying to fight this tape. And then I thought, oh, that's wrong. I should be shorting. And that worked great. So what should we be doing now? Well, it's still a difficult market to me to short because we're not at the point where it has tipped one direction or the other, and it may not. I'm going to go back over here. So what I mean by that is demand is clearly deteriorating. It is returning to the red line, which signals a top, and it's been there this long. There's still a risk, and I'm not saying it will materialize, that the price of in this case SPY proxy for the S&P 500 returns to where it was when we rose above 6. May not happen. If there's excess demand, we won't return to that. The demand curve will bottom at some point, and the supply side will reverse course. If that doesn't happen, the market is going to give back considerable ground. And to me, if it drops below that red line, it's going to do that tomorrow, right? Then I'm going to look at this. If this pops over 50%, that's not an absolute. It just tells me now there's a real supply-demand imbalance in the market that will put pressure on prices even more. We've had a little bit of pressure, and yet if you look at the underlying data, there really hasn't been much selling. Despite what you might hear on CNBC, we look at how prices are closing, what's happening to supply across the market, and it's not that bad. So it could get bad or it won't. I don't know what it's going to do, but I look at this every time, and it's the key point here is know what's going on around you. And I do this every day. I'm going to go look at the dashboard and say what's happening. How many are in the sorry about that. How many are in the momentum portfolio? We've gone from 41 to 7. Well, it's not an indication of the direction of the market, but it sure tells you, well, the ease of trading momentum has gone away. Low volatility went from 1 to 17. Everybody's trying to avoid volatility. That's all it tells us. It doesn't tell us that this stuff's going to soar. It's going to be highly correlated with market performance. It might give us returns. Like you could look at CME today. If it's 0% on a pretty good day for the broad measures, probably buy that because you're probably going to get 1%, maybe 75 basis points. Be happy with that. You really have to adjust your expectations. I talk to people all the time who so does Brian Wilson. I had lunch with Henry yesterday up in Steamboat Springs. He's up there with his family, Henry Howard. And we talk to people who say, I want to, I've got this $4,000 to trade and I'd like to be able to just make a living full time trading. And we just shake our heads, that you have to have realistic expectations about what can be done. You guys, a lot of you are veterans, you know this, and I'm preaching to the choir, but there are people who don't, that you want to be realistic and then you want to stack the probabilities in your favor and don't do what the data tell you not to do. And I still do it occasionally. Apple, I lost some money on that. Not much. I mean, I'm 20 basis points off my all-time high, which I was at the end of the year. But I'm mitigated. Right? I'm not going to take chances. If I look at the data and say I like the data, I know what the probabilities are, but broad sentiment's moving against me, probably not going to work in my favor, and I did it anyway. Cost me a little bit. Well, what's the best thing to do? Don't do that. Don't do that. Look across the dashboard. Just look at the demand-supply balances. This was the other key thing I wanted to talk about today, which is the simplicity of looking at supply and demand. It's a continually evolving short-term indicator. It's not going to tell you long-term. This is, broad sentiment is a very good indicator. I told the folks who run our managed accounts, I think that it would be wise for us coming to the end of the year to reduce our exposure to both equities and fixed income. And they have their strategies, and I know, and that's what we pay them for. But who was right? Well, we were right in the sense that the data is correct. The data will generally tell us short term what the risk is, and it might only be 1 or 2%. Well, yeah, but if you add that up over time, it makes quite a difference. And if you can avoid the 1 or 2% decline, it's very helpful. If you're looking through this, this 75% short, a week and a half ago, there were 13. Now they're 47. So all that tells me is that the conditions have changed. If I look at big tech, Brian's going to talk about big tech. Look at the supply-demand balance there. What I'm looking at, if you're new to this, I look at the demand on the top. It's a 30 trading day view, and the supply trend. When demand is great and supply declines, the prices do very well. And that happened right into December expirations for airlines and cruise ships. Norwegian Cruise Lines, one of the best performers of the year. You could look at how much time it spent above 5. Just look it up, run a 1-year chart on it, and look at how much time it spent above 5. and what the supply-demand relationship is. Those conditions exist, stuff's going to do well. I like to look at these sectors: communication services, consumer discretionary, consumer staples. The demand side's fine, supply is rising, it's below 50, but I look at those things and I say, well, I'm not buying that. That wouldn't be a good thing to buy. Consumer discretionary, it's had great, consistent demand and declining supply, but those conditions have changed. Not buying that. It's over 50% now on the supply side. Consumer staples, it's fine. But again, do I see a divergence? No, they're tracking each other. A perfectly balanced supply and demand in today's market will lead to a declining market. Why? Because there's always a spread between the bid to buy and offer to sell. So if everything is perfectly balanced, somebody in the middle is going to erode your returns. So beware, there has to be a bias, one direction or the other, to make money. Look at crypto. Where did crypto soar? When supply was plunging and, from mid-November right on through, and demand soared. Now where is it? Well, demand's still very strong in this group, but the supply trend is not good. That's not when you want to be buying these things, not when you want to be buying Bitcoin, right? You look at that and say, no, don't. I want to buy Bitcoin when the stocks that are in that industry are sharply divergent, or the derivatives that are associated with that. It's that simple. Energy. This was a great time to buy energy, right at December options expiration, surging demand, falling supply, weak dollar. That trade is over, at least for the moment. You can always come back to it. Financials, I look at that and say, well, it's not great. It's not terrible. I don't look at that and say financials show a bunch of risk, but it's just, you can get a good read on everything. What do people think of home builders? Well, home builders boomed in December. Incredible demand, plunging supply right into December options expirations. Now I wouldn't buy it, right? They're moving the wrong direction. You could say, Barry Norton might say, yeah, I might short that group. They're over 50% short, and right here is where you would short them, right? And that's the kind of thing that you can do. So in a matter of moments, you can see everything that the money's doing and everything people think, because demand and supply reflect all motivations. That's just helpful. Do all of these things determine what I'll trade? No. The best thing for me, what I like to do is if broad sentiment's moving in our favor, I want to trade momentum. I will go sort by volatility and trade the most volatile stuff, and strong supply demand divergences. If you look at I never can remember the name. I've known this company forever, Cytokinetics. They had some great data. Where do you buy that? Right here. When demand hits, is very close to, it's somewhere between 8 and 10, and supply has come sharply down. That's very likely to give you a good return. Now, could it continue to rise? Well, yeah, it could, because there's, demand's very strong and supply a little above trend, but still down day over day. That's why it's still in the group. But a lot of the returns are gone. I like to trade that, but the moment the supply demand balances across the market change, and particularly if broad sentiment, let's see here, if broad sentiment is not pulling in our direction, don't try to do it. This is where there's a budding opportunity. I might even do it after the demo. I think the market could deteriorate. If it does, I might use a short ETF to trade the market briefly. I don't know. I'll look at the data, but that's where the trade is going to be. So I think, Brian, I'm just about to hand it off to you. I have a number of other examples. Oh, one other example I want to look at, and then I'll give it to you. So SPY. Here's just another interesting thing to look at, because it's the only ETF that we have on the platform. We have it there so you can look at it. The reason we don't have ETFs on the platform is they would all clutter up our read of supply and demand. ETFs are substitutes for the underlying equities. We're measuring the underlying equities. You can then use it to trade ETFs. I do all the time, particularly long, short, levered. But SPY it's a fascinating look at the arbitrage mechanism. So, you could almost count these, like 1, 2, 3, 4, 5. That now that being short SPY has ended, and now we're long SPY, and maybe it's short a basket. 4, 5. Then we're short, 2, 3, 4, 5. Now we're long, 2, 3, 4, 5, right? Now what's going to happen? The whole pattern has broken down. I don't know what it's going to do. It should, by rights, come down further. But the trend has come down for so long that I wonder if that's going to happen. I think people are overweight derivatives, underweight the asset. That's what this long, and you could back it up and see there's a long decline on the supply side, very steady demand. You can't use it predictively. It won't tell you what direction the market's going to go per se. Broad sentiment does a great job of telling us that. But it's an interesting way to see what's occurring in the market. If you back this up for a year, it's very rare that it bounces above 5 because it is the market. And if the market's at 5 and has, the supply that runs below the trend, the whole market rises. When supply or demand's at 5 and supply jumps above the trend, what happens to prices? They deteriorate. This was the weakest period of the entire year for SPY and the entire market. And this was the strongest period for SPY and the entire market, and the only time it got to 10. Now, I don't know what's going to follow. Look what's helped us. If this continues, the market is going to recover and continue higher. If it does not, it won't. So it's just there's so much you can look at and go, I don't have to worry about what the market's going to do, this economic indicator, that thing, earnings. You can just look at supply and demand and have a very, very good idea of what's going to happen. Last thing, and because I said I would do this, SWK. So I traded SWK. Was this a good idea? Well, I'll tell you why I did it, right? So it's in the low volatility portfolio. It was down pretty sharply yesterday. It had a big supply deficiency. It was down a lot more than its regular volatility. So I did trade it. I made 50 basis points on it. But it's difficult. I wasn't sure I did the right thing because I'm bucking broad sentiment. So as my feedback, if you consider a similar trade, is that would be a good trade if you want to make 1% when broad market sentiment and demand and supply are diverging. In the current environment, it's not worth it. It's just not worth it. Do something else. It's from my own experience. And so that's what I'm going to leave you with. And Brian, I'll hand it off to you.
Tim, I've got a quick question.
Please do, James. Good to see you.
Happy New Year to you all. Yeah. It's late here. There's no one in Europe. Everybody's still skiing. It's like
as they should be.
Yes. Yeah. Just briefly on the dashboard, the 70% short section you have. Yeah. I don't see that on my dashboard. Is that because that's something that you're looking at without releasing? Is that correct?
Yeah, it's not a system portfolio. I mean, I could put it on there. I just don't want to imply that there's something, materially beneficial from that. I feel good about these.
Is there any way we can look at that just from the 1st of Jan for this trading year?
Yeah.
See what that looks like.
Yeah. So, and it's very simple. I mean, I'm only looking for stocks with supply greater or equal to 75%. That's all I'm looking for.
That's the only parameter.
Only parameter. So it's only an indicator to me of the market's short signals. Right. And this has during that August to late October period of time, there were times when there were 150 in that.
Wow.
So, we're a third of where we were then. If it gets over 100, it tells you the market it would be very difficult to trade the market long.
Yeah.
But it's just a signal. Is it correlated to market performance? I don't have that data. We could certainly do it.
Right.
Yeah.
Okay. Thank you.
You bet. Anything else that I've missed? Let's see. Brian,
I don't think so, Tim. I was going to show Amy just my shorts portfolio. Okay. It's actually kind of the exact opposite of the momentum portfolio. Okay. Good to see everyone. Let me go ahead and pull up my screen. So if you want to take a snapshot of this, if it's helpful, essentially what I did with my short portfolio is I just took exactly the opposite of the momentum portfolio. So this is the criteria that I currently have, and I'll just leave that up for a moment. Barry, I think this might match what you do, but it's literally just the opposite itself of the momentum portfolio. So hopefully that's helpful. You can see right now there's two components in it. So it's not like there's a lot of short opportunities, at least by using that criteria. There, of course, there's different ways you can do that. Tim has his 75% short portfolio that he was telling you about. I did want to. Tim had mentioned this earlier. I wanted to take just a moment to kind of walk through differences between big tech and the broad market right now. It's something that stood out to me a couple of days ago when I was looking at the market, and it's still that way today. It's what I mentioned in this morning's note. You can see right away, and let me bring this up a little bit. You can see that short volumes are declining for big tech, pretty substantial covering as well. And if you look at the broad market, well, of course, it's going exactly the opposite direction. As you all are aware, much of big tech is, what we call the Magnificent Seven. So in other words, when those components are moving one way or the other, it's going to impact the market. Names like Apple and Microsoft and NVIDIA and Shopify and Amazon and so forth. And what I mentioned this morning was, I don't know. What I mean what I mean by I don't know is let me take you to a spreadsheet here for just a second. Sometimes what will happen with big tech is it will influence what's going on in the market. And what you see in front of you is just a spreadsheet that I update every day. It's looking at all the sector components, both in sentiment and in short volume. And what I wanted to show you is what was happening at the end of November. What we saw at the end of November, broad market sentiment was deteriorating really across the board. But if we look at what was happening with the big tech portfolio, and you can see it down here, we started to get some short covering in the early part of November. So in other words, early part of December. So in other words, the broad market was starting to come under a little bit of pressure. You can see that right through here, started to get a little bit of pressure, but with big tech actually doing okay from a short volume perspective, it basically helped the market not to come under as much pressure as it might have. Are we in a similar environment right now? Hard to say. Tim mentioned this earlier, but if you look at that trade in November, we can see that sentiment was declining, just starting to decline at an inflection point. Very important from a context perspective. We were coming up at the end of a month. A new month came into play. Market got a little bit weaker for a period of time. And as Tim had mentioned earlier, we started to get short covering across the market. Will we see something similar now? I don't know. But you can see how high short volumes across the market have gone in the space of a week. That's a 4% increase in a 1 week time frame, very, very substantial. But yet, as that's occurring, once again, with big tech, it's going just the opposite direction. We're actually getting short covering in big tech, very similar to the early part of December. It's always very challenging to have an apples to apples comparison. But I'm thinking that maybe lower short volumes in big tech might help us not to have as severe a downturn. That may or may not be true, but we'll see what happens there. That was the first point I wanted to cover. The second point is kind of along the lines of context. If you look at this movement in short volume over the course of the last week, that's a very severe move higher. Take this out and look at it over a 1 year standpoint, it's still a severe move higher, but you can see that we're still below that dotted line. So even though we've had, quite an updraft in terms of short volumes, maybe we move the other direction like we did in early December, and maybe we continue to move forward, with this rally. So my 2 points, just briefly, watching big tech because short volumes are moving the opposite direction to the broad market, and remembering just to kind of pull that context out once in a while, give yourself a longer time frame, to see what's happening over the course of the last year, or you can skin this different ways. You can look at it, on a 6-month standpoint, but when you look at it over different time frames, it gives you kind of a big picture perspective. So that was the 2 points that I wanted to cover today.
Good stuff, Brian. Okay, questions? Yes, Terry. Good to see you.
When Brian was showing how he drafted that portfolio with the various criterion, does it matter what order those are put in?
I'll opine, but Brian,
sure.
Correct me
if you.
So we say demand always outranks supply, but the relationship is very important. You can't omit one.
Okay.
Yeah.
Right. And in that case, Terry, I don't think for that portfolio the order matters. But Tim is correct. You don't want to miss any of the components. You want to make sure that you capture all of them.
Sorry. So say that again, Tim. I think I missed that part. I missed the answer. You said that it's important to have one before the other.
I was just mentioning that as long as you capture all those components, you should be fine.
Okay.
The order there should not matter.
The order doesn't matter. Okay, that's all I want.
Yep.
That's clear. Okay, thank you.
Yep.
Do you have a percentage, Tim, on when you say demand is strong, is the leader versus supply? Because I've watched so many times where supply overpowers demand.
It can happen. I agree with you, Steve. That's the central tendency. But if we run, so yes, we do. If you run a correlation coefficient between supply and the broad market and demand and the broad market, or in individual securities, the correlation is higher to demand than it is to supply. But there's no question that, what is the spread between that? I think the correlation spread is about 18 or 20%. So that means clearly supply plays a very important role. And I look at it. If supply moves 10%, and as soon as it turns, I'm aware. If it moves 10% from wherever it is, and I own something, I'm out, because if I'm long, that is, because I know that that's going to deteriorate performance. And what we find very consistently too is you have 5 days. It doesn't mean it's going to be exactly 5 days. That's just the central tendency. So, if you're trading something and you say, oh, wow, supply just jumped, you don't have to panic. It's probably going to have a carry through, and you may have seen that, Steve. But it has told you that within 5 days, and the sooner the better, particularly if you've gotten your gain, that you might as well move. If it's only moved 2 or 3%, that is not a trend. That is not a meaningful change in the supply-demand balance, and you don't have to react to it. That's what we've found.
Okay.
Ileana, let me answer your question. I was starting to type an answer to it. I keep a semiconductor and an AI portfolio. So Ileana said, any thoughts on semis or the AI theme as they relate to tech and broad market? They led last year. So what does that mean? Does that guarantee they're going to be the worst next year? No. But, Ileana, it's often the case. It's often the case that the best performers one year are near the bottom the next year. And that feeds back to the way that market structure works. I don't know what they're going to do. I certainly look at them. I don't use them for trading signals, but because I'm not trading those groups per se. But for people who do, it's a very good way to do it. Look, if AI has great supply-demand divergence, trade that group. If they don't. And what will they do next year? I don't know, but I can tell you how ETFs work. ETFs are using stocks as collateral, and they tend to, at some point you have to square your holdings with an index. Believe it or not, they have a lot longer than you might suppose. 13Fs for reporting institutional holdings occur 45 days after quarter end. So if the quarter ends June 30, then you get that data August 15th. Well, ETFs have longer than that. They get almost 70 days after the end of the quarter to be square, by which time the whole index might have changed. My point out of that is what tends to happen is that you're overweight a bunch of stuff that performed very well and causes tracking error. You're going to be underweight it in the next couple of periods. And the effect of that is that stuff like Enphase and energy that were awesome last year are terrible this year. It's not the only reason, and you could come up with other explanations. But if something that does well in a year or in a 6-month period, I'd be very wary of. Everybody forgets that NVIDIA was down 65, 70%, lost 65 or 70% of its value before it went up 300%, right? And when you lose 70% of your value, gaining 300% may or may not get you back to all-time highs. Keep that in mind. You run those calculations, but that's how the market works today. Brian, you want to add to that?
Can I add to that?
Yes, please do, Barry.
So the way to trade semiconductor using Market Structure Edge is to create a portfolio with all of the 25 components from SMH. And then you get a broad, when you get your top screen, you get a feel for where they're going. Then when you drill down into the portfolio, you can see, and then it comes down to 9 stocks that have the highest have the best option change, the most liquidity in the options change. And so if you want to trade semi, focus on those 8 stocks, and you can go look at what they are just by looking at the options change. But that's a good combination of first looking at semiconductor as SMH, which has all the major players in it, and then focusing on those 8 stocks that have 8 to 9 stocks that have the best options change. And that's a great way to play it. And your point to NVIDIA was, last year it was the poster child for AI. It's already had to run. A lot of that's baked in. They're still going to do great, but there are better options inside of semi than NVIDIA.
That is great value, Barry. That is a good note to end on. Hope everybody caught that. I appreciate that. Yeah, good stuff, Barry. All right, you guys, we went a little bit long, but it's worth it.